Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing on social media. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. That's where I dive deeper into all of these topics. I share my opinions a lot more freely on the individual companies that I am investing in. We do have training sessions, technical analysis training sessions on there, and cycle analysis stuff. So take a look, and we have a coupon code Mayday, MAYDAY, still active, which will turn into Happy July tomorrow. So coming down to Josh Young, he says, major breakout from the 5-year freight recession trend, perhaps signaling a sustainable recovery in U.S. transportation activity, which is bullish oil. So this is outbound tend to reject index, which it shot up on that money printing move. Coming on up, it was elevated for a good year and a half or so, and then we've come back down, and this is a rounding bottom that we're seeing, and a breakout recently of previous highs. So now we have a new higher high, signaling a potential breakout for freight recession trend. So, or I should say, freight trend. So that's looking good, and is opposite of what some other data that we look at, like unemployment is going up. There's other metrics that we see that are showing a slowing, but this is showing an increase, which is good, I guess. Some information. Mark Emerson, someone wanted me to talk about this, so I'm going to talk about it. It's a member on the website. I'm just going to share it here. There are almost as many residential construction workers today as there was during the peak of the 2008 housing bubble. There's also currently about half the amount of housing starts, an oversimplification, but I don't think I'd want to be a construction worker here. He's got about 1,008 for all employees, whatever unit of measure that is. And then this today is about 949. And housing starts is at 1,277. Housing starts here, we're at 2.2 million. So what's going on there? Well, we very well could be having a little bit of a slowdown. You can see that we've had a downtrend here in housing starts. And I think that the industry has ramped up construction workers to build all the homes that are necessary to fill the deficit. It's going to take time, though. We are at a level where affordability is pretty rough. And I think that's probably having a pretty big impact on home sales. We've seen home sales are down. So what it's doing, and if I were to roughly describe, is if you have a bell curve of affordability of homes and all the buyers, you're basically pricing out. Maybe you're at the 75th percentile of how wealthy someone needs to be. And only the top 25th percentile can buy homes, and the bottom 75th cannot. And that is due to the affordability, interest rates being the main driver. With interest rates where they're at, that could be having a negative impact on all of these areas in real estate, because a lot of it is affordability. You have to take loans out in order to buy it. And obviously there's people who don't need loans, but there are a lot of people who do need loans. So we could see a slowdown in the market, and that could impact construction employment. Construction employment has not rolled over yet. It is still very high. And I think that's due to where we're at in the cycle. And in the cycle, we're not in a 2008 bubble. 2008, they had a bunch of construction workers. We had a bunch of existing home inventory, a lot of foreclosures, and housing starts were still up there supplying a bunch in a hyper supply phase. We only have 3.5 months of inventory. We are pretty low in terms of existing home inventory. The completed homes for new homes has crept up, but it's not at extreme levels yet. So yes, we could have a slowdown due to affordability, but if they were to lower interest rates and the affordability were to get better, I would say that we're probably going to see home prices go up, and then we're going to see volumes of homes sold, home sales go up as well. And I think that's basically Powell is dialing that affordability through the interest rate. That's your monetary bank lending that he basically crushed to slow inflation in 2021, 2022. The Kobayashi letter. So this is interesting. Hedge funds have been selling U.S. tech stocks at the fastest pace in at least 7 years this month, according to Goldman Sachs. Semiconductor stocks have been the most heavily sold, followed by software and internet stocks. This comes after NASDAQ 100 has rallied 18% year to date and 40% since October 2023. At the same time, the semiconductor index SOX has skyrocketed by 30 and 70% respectively. As a result, SOX relative to the S&P 500 has exceeded dot-com bubble levels and traded near all-time high. Are hedge funds turning bearish of tech? Well, depending on how much you own, and this is the selling pressure that it's seeing, depending on how much you own, if you own a lot of a stock, you need volume to offload that stock onto. So, I mean, the book, Reminiscences of a Stock Operator by Jesse Livermore, he had to sell a bunch of stock for insiders, like a bunch of it. And he needed volume to do it. He needed people to be interested in buying the stock. We have the volume now, and these guys are probably selling into that volume. They're selling into strength is what they're doing at a very expensive valuation. They're doing exactly what I would do. Sell into strength. If you owned a lot, if you owned, billions of dollars of stock, I would sell it into strength and let the retail sector eat the losses. Brandon says they want to achieve net zero by 2050. Fine, you need a lot of metals, which require a lot of these trucks, but they also want these trucks to go electric. Okay. How many fossil fuels do we need to power just one of these monsters? Net zero is a myth, folks. Look at the size of this thing, guys. Absolute monster. Lots of steel, lots of aluminum, mainly steel. So that's where steel is going to ramp up, is when we try to do this net zero stuff, we're going to have to mine like we've never done before, and we need a whole bunch more of these. Steel demand is what I'll say. What are the monetary canaries in Sweden and Canada telling us about what will happen in the US? See this chart. It says Sweden manufacturing details lead the US in global inflation momentum. The cyclical momentum in prices will be back during the second half of 2024. So this is the US Consumer Price Index, which is a second derivative. And these are Sweden. Orders and inventories are going up. Well, that's interesting. I thought we were in a slowdown. I thought people were worried about a slowdown, and this is saying the exact opposite. Well, it's data, and not all the data is aligning with each other. We're getting a housing market slowdown, which I agree with. We are strengthening here. We're strengthening on our freight shipping. Kind of interesting how all the data is not in alignment. And that's where it gets real difficult to try to forecast what the market might do in the future. Focus on value because most investors focus on outlooks and trends. You must be a fundamentalist to be really successful in the market. Sir John Templeton. And I've incorporated one of the pillars to look at relative valuation, which is ratios. It says, attention, the M2 money supply is now expanding, and it never actually got to this level down here negative. They were releasing a bunch of money from the reverse repo back into the market. So the money was created originally in this gigantic boom over here. They sucked money out and left it in the reverse repo, and then they brought it back in when this went negative. So they are controlling the money supply, I think, more evenly than what this chart is telling us. Now they are printing money if you look at the M2 money supply. And the reverse repo, some of it's going into the reverse repo too, because we've seen an increase in the reverse repo. It says buy during fear or when no one wants to own it, sell when everything looks good. And this is greed, buy, fear, sell, repeat until broke. And then obviously I've got Buffett. He says, be fearful when others are greedy and be greedy when others are fearful. So you want to buy when everyone's in this fear sell stage. You want to buy a whole bunch here. You want to sell up here. And it sounds really easy when you talk about it, and it makes logical sense. But your emotions get in the way. So how can you reconfigure the way that you think where you become fearful when you're up here and you become greedy and buy down here? It takes a little while to reconfigure your brain to do that. And I'm still trying to reconfigure mine completely. Because sometimes I catch myself and I'm like, wait, this is really low down here. I should be buying more of this than maybe some that are starting to break that are up here. So I never buy when they're at tops up here, but some are coming out of bases up here. You do get momentum, and that's the technical analysis buy. The fundamental buy, if you're going for absolute bottom to top, real hard to buy bottoms because you have to be patient. You got to be really patient. You got to be really, I'll say, a contrarian versus everyone else. All things ventured, even if peak oil demand comes sooner, which is doubtful, tanker demand will continue to grow meaningfully through at least the early 2030s, as growing oil production from the Americas must be shipped long haul in ever greater quantities to replace significant declines in Asia. So we're going to see a lot of tanker demand all the way up to the early 30s. Brian says, good investing is consistently holding solid investments even when your emotions are screaming at you to sell. I totally agree with that. And I have really worked on being able to hold longer and basically beat the emotions out of me. And that's also, I bought when there was a bunch of fear in the market. I bought it when it bottomed and then it was starting coming back up. I bought it real low, like oil and gas and a lot of those other ones. And then the second portion is, if you're good investing, consistently holding solid investments, even your emotions are screaming you to sell. We had a couple of 50% pullbacks in some of my stocks, and it was pretty rough. It's not easy to hold through a 50% pullback. I've had multiple 50% pullbacks. Some of them went down dramatically in terms of total dollar amount. My entire portfolio definitely went down in a couple times because a lot of the stocks do kind of trade similarly in the sectors. So I went pretty heavy into oil and gas. I made a bunch of money in oil and gas from 2020, even until today. I still hold those holdings. And some of those pullbacks were pretty bad. I will admit that. If India's infrastructure build-out continues, it may be a significant tailwind for copper and other construction commodities. Go Rosen, which is the Rosenswag team, estimate that today India has 15 pounds of installed copper per capita compared to 260 pounds in China. It's unreasonable to expect India to repeat China's meteoric rise, but even if we slash the target by half, India needs 8 times the installed copper per capita to catch up to what China is today. At scale of 1.4 billion, we're talking about some serious amounts of copper over the next 20 to 30 years coming from India alone. And this is the installed copper S-curve, which is real per capita GDP. And if India goes through this, guys, copper demand is going to be through the roof. We don't have that out there. God, this is going to be a huge squeeze in all these materials. And I hate to say it, guys, but you know what copper demand really is? I mean, a lot of people look at it and they say, oh, it should, I should invest in copper. You know who's going to make the money? Oil. Copper is a derivative of oil. So copper is a conversion of oil. And really what this is when ore grades go as low as they're at, your input of energy goes up exponentially. we are going to see, I think, gigantic demand for energy. And this is part of that demand. You've got all of these things occurring in the world, AI data centers, electric vehicles, the mining of all of these minerals, the installed copper S-curve of India here. It's all future oil demand. All of it. I don't know how we can get off of oil even, because if the copper doesn't exist yet and the infrastructure to charge your vehicles are not there, if we do get short on copper, we can't adopt the electric vehicles as quickly as we would like. It's all going to manifest in copper shortages and then the energy needed to produce the copper that everybody wants. Two of the most aggressive spenders as the President of the United States since FDR back to back. Look at the spending here, guys. My Lord. And that doesn't look like it's slowing down. It looks like it's increasing rapidly. Metals weekly price performance. So the top performer last week was palladium, up about 6%. We've got zinc up about 3.3%. Uranium was up a little bit. Lead, aluminum, nickel, platinum, and gold kind of just treading water. The worst last week was manganese, tin, molybdenum, lithium, and vanadium. Art Berman says Canada's oil now has nearly 600,000 barrels per day of additional market access. Canada could be the largest source of increased oil supply across the globe in 2024. Yeah, that's why I'm investing a buttload in Canada. It makes sense. The time to get bullish bonds and bearish stocks, it's short the stock bond ratio. Is when unemployment turns the corner, aka recession. History of the stock bond ratio. So we've got stocks and bonds. Unemployment rate is also put on here as well. So when we see the U.S. stock bond ratio roll over, you can also see the employment roll over, and that's when you get a slowdown in the market like we got in 2001. We had another one in 2007 where everything started to roll over, and the crash didn't occur till later of 2008. We do have a rollover a little bit in unemployment here. Now, if we see the move in stocks to bond ratios start to go over, where stocks start to underperform bonds, then we could see a potential slowdown, but I think it will take some time here. So be patient here. It's not time to panic yet, I don't think, but it's going to take some time. So this rolled in 2000, probably 2000, 2001 here. And that's when you start to panic, is when they're both falling. We don't have that yet. And why does that matter? The insiders know that rates are going to decline, so they front run the Fed. So you'll see the bond market go up before unemployment becomes problematic, however I say that right. My favorite quote about discounted cash flow models: we're all just guessing, but some of us have fancier math, says Josh Brown, which is true. Another quote here: we do better in worse times. In good times, everybody's optimistic. Security prices go to the moon. In bad times, people are more worried, and so they let security prices decline, which is attractive to us. Again, buying into fear. And you don't want to be buying when there's greed. That's exactly what Howard Marks is saying in this quote there. Everyone is now chasing power. 85% of all new data centers built in the next 3 years will be outside of Virginia. The transition has happened so quickly that the primary markets across the U.S. already have significant power constraints, which has led to the rise of what TD calls the anywhere deal. Everyone is now chasing power. They are willing to look everywhere for it. That's why land values in Columbus, Ohio have quadrupled. Parts of Chicago have tripled just because the land has access to power. All across the nation, data centers are springing up in new secondary markets. Meta is building a giant data center in Kansas City, Missouri, fueling what its utility is calling the most robust electricity demand growth in decades. AWS recently announced plans to invest $10 billion in data centers in Mississippi, the largest capital investment in state history. Even energy providers in the Rust Belt, states like Pennsylvania and Kentucky, are seeing data centers with large load requirements cropping up. As quickly as this has happened, states are realizing the predicament they've put themselves in. In Arizona, one of the new primary markets for data centers, the number and size of new hookup requests just kept increasing. So the state's largest utility put a temporary ban on all new data center hookups. Initially, Atlanta was excited to become a new hub for data centers, but now Georgia Power is warning of power limitations. It's a challenge like we've never seen before. There's your data centers and the power that everybody is thirsty for. Now the question is, what is going to generate that power? And if everybody wants it now, what are we going to build to satisfy that? In my opinion, it's probably going to be natural gas. That's my guess. And that's where we're going to end it for today, guys. So that's what we've got. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website as well. And that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.